And sometimes what investors do is because they follow other people's advice without knowing what they're doing, they'll buy the wrong stock at the wrong price.
Yeah.
And sell the right stock at the wrong price. Wind up having a portfolio that looks like a yo-yo. And they'll tell you, but look, I made money. But if you look at the whole picture, maybe you didn't do as well as you could have done if you had the right strategy and the right people behind you.
It's a lot about discipline as well. And again, I'll go back to that behavioral finance. Like one example, I use this, and I'm always curious to see what somebody's going to say, but I'll say the majority of people answer this the way I'd expect. And the question is, if you're buying stock A and stock B, and let's say you bought $5,000 worth of stock A and $5,000 worth of stock B, and the stock A goes up by 10% and stock B declines by 10%. And now let's say you're going to go on vacation and you're choosing to sell one of those stocks. Which stock do you sell? Do you sell A or do you sell B? Now, I'm not going to put anybody on the spot, but maybe for your viewers, just think about this. Would you sell the one that went up and you could say, hey, I took a profit? Or do you sell the one that went down and you're saying, I basically took a loss on that? Now, when I ask this question, and I've asked it a lot, most people say, well, I can't sell the one that took a loss. I have to wait for it to come back because it's going to come back. And I'm going to, as a famous TV personality says, I'm going to ring the register and I'm going to sell stock A and take that profit. But the reality is momentum tends to work. Relative strength tends to work. It's in the math and it tends to work. Doesn't work all the time. But you should sell and cut your losses in stock B. There's a reason why it's in decline when this stock is moving. There's a relative strength issue here. So most do-it-yourselfers, they tend to say, like, I want to notch a win. And I haven't really lost any money yet because I haven't sold this. But they're acting not in their best interest because they haven't done the research. They haven't done the math. And so their ideas are flipped, is what happens.
But also I think that a lot of people get the wrong advice overall because they're taught to keep their losers because they know they'll go up eventually. And they're taught to take profit off their winners. Why would you sell something good?
Yeah.
Just hold on. I mean, one thing Buffett does, he buys quality and keeps it.
Keeps it for a really long time.
Yes. But people do invariably, though, they'll buy quality. It'll go up and say, okay, I've made my profit. Let me get out of it. Why are you getting out of it?
I use a bunch of analogies. So a favorite analogy is, especially if somebody doesn't watch or like football, and I'll say, do you know anything about football? And they're like, no, I hate that sport or whatever it is. And I'm like, okay, great. So that's perfect. But you do know football exists, right? And they're like, yeah, okay. I'm aware that it comes on every Sunday and Thursday and sometimes Monday and whatever. So I'll say, if I had to ask you which teams are going to do better in this coming season, the teams that made the playoffs last year or the teams that didn't make the playoffs last year, as a group, which do you think is going to do better? The teams that did really well last year or the teams that didn't? Like the teams that didn't, are they going to regress back to the mean and just all of a sudden do great? And the teams that just really did well, they're just going to fall off and it's going to be kind of a flip-flop. They're like, well, no, the teams that did great are going to keep doing great. Yeah. And why is that? I don't know. Yeah, you don't even need to know. You don't need to know. It could be the coach, could be the players, could be youth, could be the offense, could be the defense. You don't need to know. But you do know they're going to outperform. And so the analogy is we bet on the stocks or the companies or the sectors that are making the playoffs until they stop making the playoffs. It's a relative strength thing. It's a pretty easy analogy that works in stocks. It works in companies. It works in countries. It works in sectors. But eventually the stock will stop making the playoffs. And then there's a relative issue with that. And you kind of step back and say, I don't necessarily need to be playing or betting on that team anymore. Don't get married to that team. Like, it's not your home team. Like, I'm a Pittsburgh Steelers fan, which I probably lost a bunch of listeners for that, but I've known the Steelers since the 70s and just love the terrible towels. And I was a receiver growing up. So Lynn Swann and John Stallworth, they were kind of my heroes and everything. They're not going to make the playoffs this year. So, but I'm still going to be a diehard fan because they're the Steelers. But don't treat your stocks like that. Don't treat your investments like that.
I think the bottom line is, particularly for the DIYers, just do a little homework and find the right people.
Yeah.
And just do a little homework. And that's why we're on this show today. So they can meet you and meet me, but you can find that by looking around. Somebody who knows what they're doing.
100%.
Listen, KAM is Kruse Asset Management. What's the market forecast? And what should the investors do now?
So that's a $64,000 question, right? Everybody's kind of wondering this. We talk about this daily within my office and have spirited debates about what's going on. But this is what I'll tell you. And again, this is mathematically driven. Back in January, we put out a video, January 6th, not the auspicious January 6th day, but January 6th of this year. We put out a video that said the PEs of the S&P, the forward PEs of the S&P were above 20, 21, 21 and a half. From that point, in the history of the stock market, we have never seen good forward 5-year returns. It's never happened. So you've seen the best. The pinnacle was a roughly a 5 or 6% annualized average return. That was the best that we could hope for. But when you looked at the regressions and the numbers, the average annualized return was 0%. So what we argued were, you're going to get at best mediocre returns, expected returns of 0%, and maybe at worst a pullback. And alongside of that investment, you're going to have volatility along the way, of course, because you're invested in the stock market. So the risk reward wasn't there for us. And so we started reducing our risk. At that time, inflation was 1%, right? So we did reduce a bunch of risk in our client's portfolio. And then the market started breaking down from a technical standpoint, and from the relative strength, the whole football analogy, equities, large cap, mid cap, international, emerging markets were all going out of favor and all looking to be like they weren't making the playoffs. So we pulled back further out of our equities. And as everybody knows, the market fell 20%, rallied from June to August. It rallied for 60 days, and another 10% back and 50% retracement. So what does that mean? From top to bottom, it retraced back more than 50%. And that is often a sign that the bottom was in. So it just barely made over 50%, but then it installed another bottom and went through those bottoms again. So today, you asked me, where are we today? Well, the long-term average PE of the S&P 500 is around 15, call it, okay, 15, 16. So PE is, what am I willing to pay for $1 of earnings today? Price divided by earnings, PE. So a $15 PE, saying I'm willing to pay $15 for every $1 of earnings in the S&P 500. That's coincidentally kind of what Apple was trading at for quite some time pre-COVID, between 12 and 18. It was averaged of about a 15 PE. Very reasonable PE. So we were trading at interest rates of our inflation rates of 1%, and Fed funds rate was at 0, and the 10-year was, hit 50 some basis points. I mean, everything was compressed. So all those forward earnings of a company could be discounted back to almost the same dollar today. So that PE could expand because interest rates were really low. So there's something called the rule of 20. So if you add PEs plus inflation rate together, and if you're over 20, the market's expensive. So we were already over 20 with the PE ratio, and if inflation was around, let's call it 1%. So maybe that PE plus inflation was 21, 22, 23. So over 20, so expensive. And that's where we called the market and said, let's get out. Incidentally, the market peak was January 5th. So we were pretty close. Today, the PE of the market is 16, 17, somewhere in that range. So not cheap. And normally you see the market go from expensive to cheap. Like we went through expensive, and normally if you look at it, it doesn't stop at fair value. It goes through fair value to cheap at some point, especially in a downslide. So we're still expensive, but inflation is no longer 1%, it's 8.5%. So I could argue that if we're at 16 multiple plus an 8 inflation handle, we are arguably more expensive than we were in January because of the inflation rate. I could argue there is another, we're halfway to this. If you look at all the recessions that we've seen in the last, 50 years, like 8 or 9 of them that are this type of recession, if you look at the average length and the average pullback of those last 8 recessions, not including COVID, because I would argue COVID was a anomaly, right? You had top to bottom decline of 36%. It happened in 33 days. It was the fastest top to bottom decline we'd seen by a factor of 2. The Fed threw $6 trillion at the problem. And now they are actually taking money out of the economy, not throwing money into the economy, right? So the exact opposite mechanics is happening. So if I take COVID out of that, of the last 9 recessions, they lasted over 500 days and had a drawdown of 40%, 40%. So we're 10 months in, just 11 months, I guess it's November. So we're about 11 months in now, and we're about 20% down, hit a bottom of 24 and change. So I could argue we have another 6 to 9 months to go, just to get to average, not even to get to a bad recession, just an average pullback. So I could argue we'd have another 15 to 20% to go and another 6 to 9 months. Now, if we look at what's happened, the Fed, as you know, raised interest rates another 75 basis points yesterday. They've had multiple 75 basis points in a row, but none of those raises are in the economy yet. None of them have worked their way into the economy. So none of those headwinds have hit the economic landscape. So we are having this pullback based off of still all the stimulus and none of the quantitative tightening that the Fed is engaging in right now. And that usually takes about 6 to 9 months. And so the 3 things that have preceded every recession we've ever been into have been Fed tightening, which we have. Now, one of these 3 things precedes. So Fed tightening, which we have. Inverted yield curve, which we have. So not only the 2 and 10-year extremely inverted, but the 10-year and the 3-month treasury are inverted now. That's an extreme position. So the federal government will pay you more for a 3-month treasury than they will pay you for a 10-year treasury. It's a really extreme position to be in right now. And higher energy costs, which we have. So we have all 3 of those conditions that have met right now. Most economists would suggest we are not in a recession today, but yet we're probably going to be in one. So that says things are going to get worse, not better. So again, you asked me where we think the market's going to go. The market tends to look forward 6 to 9 months, but 6 to 9 months is about when all these things from the Fed tightening landscape hit. And it's about when we're predicting a recession. So we're looking into the recession. So markets often can look through a problem, but we can't see through it yet. We're not even in it yet. So we don't know what's coming. So what I think is going to happen is we're going to have another leg down. So we called after that rally, we called for leg down. We reduced equity again. I wasn't sure if it was going to break the low, but since it did break the low and 2/3 of the market trades on technicals, we expected some sort of Santa Claus rally and then another leg down. So my supposition is we're going to get another leg down and perhaps have some more pain ahead of us. And my final point to that whole thing is, again, we're down 25%. This has been going on for a while. If I've been doing this for coming up on 25 years now, normally when you see a breakout point or a bottom, you see panic at some point in the market. You see just indiscriminate selling of everything. And we just have not seen that yet. Like there have been some big day losses. There have been some days where it's been down and it's not been fun to be in our position where you just see a lot of red on the screen. And we've had huge rallies, but we haven't seen any panic selling yet. And almost always that's what it takes to call that bottom. And we just haven't seen it. So, and it normally like trends down, up, down. Like even in the up markets, you see down months. And so in the down markets, you're going to see up months. But that last down leg is usually steep and we just haven't seen it. So I think there's a lot more risk to the downside than missed opportunity to the up.
Wow, we covered up. You know what? We're getting ready to wrap up our session together today. First of all, I want to thank you for that. I want to thank you for your presentation, everything you talked about today. And for all the people that are listening, either whether they're listening presently or listening to our replay on YouTube, I want to know how to reach out to you and tell us also what type of client you will accept.
So, we would want to work with the people that we can help the most, right? Is it the person that it has like an account that's $50,000 and, you know, they're not making a boatload of money. And there's not a lot that we can do for them. I am happy to meet with any friends and family. I've always had that policy from the beginning. I am happy to meet with you. I'm happy to we'll give you a free analysis of your portfolio, even if you're not our ideal client. I have seen so many bad portfolios and bad advice out there that it actually pains me. It's a whole nother show of just like amazingly bad advice, but we will give you a blueprint on what to do and how to do it. But an ideal client is either a high income earner where we can help them with both aspects, help them with our lane of financial investing, and on the virtual family office side, help them mitigate their taxes, help them plan for the future, help them put their insurance in place for premium financing. If they're business owners, help them with, you know, everything that goes along with that kind of business side. So my typical client tends to be, you know, $2 to $10 million. I've got clients below that, clients above it, but that tends to be my sweet spot of where we play. So we do have people in our firm that are not as gray-haired as me. So, you know, they are happy to talk if you don't want to talk to somebody as old as I am. We have CFAs at our firm as well that can talk to you that maybe have a little bit more relevance to what you're going through if you tend to be a lot younger than I am. So happy to talk to anybody at all, because we do not want to be, so I don't want to be in this business for greed and to just say, hey, you know, you don't have quite enough money, we can't help you. We want to make sure if you're coming through our door that you're taken care of. Number one, first. I don't want you to like walk out and go, oh, that was not helpful. We will give you a blueprint on what to do. But how you get a hold of us? Best way to get a hold of me would be Stuart, STUART, at KruseAM.com or KruseAssetManagement.com, all spelled out. And Kruse is KRUSE. You can reach out to me on LinkedIn, which is LinkedIn at Kruse AM as well. And then we have a YouTube channel that you can see. Again, Kruse AM. And so those are probably the best ways to reach us.
Stuart, thank you for being with us today. And I want to tell our audience, thank you for being here as well. And reach out to us if you're looking to market yourself or your business. Again, that's moneytalkviewpoint.org. Stuart will also be our host for the December 1st show. And I'm out of the country, so my daughter's at school in France. I'll be in Europe for December and parts of January. So Stuart's going to do the December and January show. And thank you so much, Stuart.
Looking forward to it.
For our show today. And thank you for being our co-host for shows going forward.
I appreciate the time.